Hey everyone, welcome back to the channel. Today we're going to continue looking at Amazon. Today we're going to do a kind of comparable analysis here on them, and you can download this in the description below, but I've really compared them to two groups of peer companies. The first group is retail e-commerce, and the second group is cloud providers. For the retail e-commerce, I went with Walmart, JD.com, and eBay. A little bit of Googling, this is kind of what I found as people considering to be kind of the best comps on the retail side. And I think if we look at this, you'll notice on a sales basis, right, it, you know, hovers pretty low. I mean, if you exclude eBay from that, right, I mean, looking at the median there, 0.8, but Walmart and JD both very low sales multiples, presumably because they do a lot of sales. eBay a little bit higher, but I think their sales numbers might be a little bit different. I don't know if they report total per se, like total sell value. They might just their revenue number might just be the commissions they earn. Um, so they do have a little bit higher of a multiple there. Then if we look at enterprise value to EBITDA, I mean eBay and Walmart both hovering around kind of that you know 10 low teens. JD is obviously a little bit higher there. EBIT JD is pretty high, but then eBay and Walmart are pretty in line with each other. It looks like. Um, but I think interesting thing if you look at LTM EBIT margins, JD you get pretty low margins, and Walmart you get low margins, and it's pretty similar to that of Amazon. So I definitely thought that that was kind of an interesting thing to look at. And then if we just look at LTM price to EPS, kind of all over the place. eBay trades at the lowest multiple, which kind of thought, I guess maybe that makes sense, but definitely interesting to look at kind of the retail. But I guess the takeaway here for the retail is that they're pretty low multiples on these factors. Um, so something to keep in mind. And then if we go down to the cloud providers, right? So Microsoft, Alphabet, Alibaba could actually also go up in the retail, but I think I think they're ranked as like the fifth largest cloud provider or fourth largest by a lot of companies or a lot of firms out there. So I put them in the cloud provider space, even though I think they are probably the best, one of the better peer comps to Amazon, even though they are a Chinese company. And then IBM is the last one there. But you can kind of see based off like sales, it's kind of all over the place. And the thing about this is like cloud is such a small part of these companies' total revenues, really. Um, but it's expected to grow like crazy. Like I think Microsoft cloud revenue was like 15 or 16 billion, I think is what I remember. Or Alibaba was 15 billion and Microsoft was 20 billion, something like that. So I mean, it's a lot of revenue, but it's not right. Microsoft has, and same with Alibaba, they have vastly more revenue coming from other streams, other sources. So I think it's hard to parse out the cloud business specifically to value. Um, but definitely interesting. Another interesting thing to note here is if you look at percent of 52-week high, you'll see both the like Chinese companies are super low. Leads me to believe there's been like a lot of, just market perception changing around investing in China, which I thought was interesting to see. Because you can see all the other companies are trading pretty close to their 52-week highs, but the Chinese companies aren't. Um, Kind of interesting to see. But anyways, and I mean, you can see the multiples here obviously are much higher for these kind of tech cloud companies than the ones over here. I mean, surprisingly, actually, the mean is pretty close for both of them. But I think that's just because, you have a big outlier here with JD.com. So maybe the median's the better way to go here. And if you look at the median, right, medians are, almost, at least for LTM, they're, you know, vastly higher for these cloud companies. So I think interesting stuff. And then I think if you, combine all of these, right, look at the medians there. But I think the interesting thing now to really compare it to is hopping down and looking at Amazon, right? So this is an interesting one. Amazon trading similar 52% week high as all the US based kind of tech and e-commerce companies. LTM sales, right? They're not trading at the best LTM sales multiple, but my guess is that's we have to look at this similar to like an Alibaba, kind of like a Walmart. Like their revenue is heavily driven by just like the GMV that they do on Amazon.com. So, they're selling a ton of stuff. So I would expect this multiple to be a little bit lower. Um, LTM EBITDA, right? So they trade at a much higher multiple. So this, in a sense says like either their EBITDA is lower, which I think is definitely the case. So it trades at a higher premium. So there's a lot more kind of growth priced in there compared to some of its comparables, right? Like this is, besides JD.com, this is the highest um, LTM EBITDA. And, if you jump over to the margin column, right, 1.8% margins at JD and 9.8% at Amazon. So they have, pretty low margins. So of course, right, if we're looking at enterprise value, um, you know, large enterprise value, but pretty low EBITDA. So it seems like they're going to be trading at a higher multiple for, trading at their valuations. Um, it kind of normalizes out. And so I think that's kind of a big part of it, right? You see it drop, what, 12x there, or, 12, and you see it drop another 4, but like 17, 13, you're getting a lot closer there based off future projections than you are here. So, they kind of are expected, I think, to really ramp up the EBITDA margin. And that's something I think when we build out our projections, we're going to have to take into account of um, increasing margins when we build out that DCF and see how that kind of impacts the valuation from that standpoint. Then if we look at EBIT, right, I mean, it's even worse. I would guess their EBIT margin is pretty low. I didn't calculate it here, but I mean, they traded a higher LTM EBIT margin than anyone else, which is, um, pretty fascinating. And obviously, it's expected to drop in half, but still going to be vastly higher than any of its peers. And then, like I said, their margins are just crap in comparison, right? Their EBITDA margins are similar to that of a Walmart, right? You don't want Walmart margins to be a company that's, you know, second or third biggest company in the world, depending on the day. I would expect pretty good margins there, but kind of surprising to be honest. Um, then EPS, right? Obviously, they don't have very much earnings, so they traded a super high multiple here. So I think there's kind of two ways when I look at this that I would interpret it. It's either they're plowing a ton of cash back into the company and infrastructure and just expansion, hiring people like crazy, opening distribution centers they don't even need yet for future demand, buying data centers, right? Like just plowing cash back into the business and it's just destroying EBITDA margins. And I mean, obviously this wouldn't include capital expenditures, so um, there's got to be something else going on there. And my thought is in COGS, if they're just buying a ton of data centers, maybe instead of like capitalizing that, some of it's coming in through COGS, all the additional personnel in the warehouses, if they're opening up new warehouses that aren't fully at capacity yet, maybe they're just hiring a ton of people. I don't know. It'd be interesting to dive more into their financials to kind of get a better idea of that. But they definitely trade at a higher multiple than all their peers, and it's it'll be interesting to walk through their financial statements and see. And for transparency, this data comes from CapIQ. So I have CapIQ access, and I can just download this. So in all honesty, I have not scrubbed their EBITDA numbers. I don't know if, I mean, this should exclude depreciation and amortization, but you never know. Maybe there's some amortization, depreciation in there that's hitting like COGS line or something that doesn't get backed out by CapIQ, but usually they're pretty good at that stuff. So, we'll calculate an EBITDA tomorrow when we build out a DCF and see if we're getting something similar to this. Um, but thought I would just throw the multiples together because I think they're interesting. And I think if we're going to have EBITDA expansion over the next decade, right, we should probably have it approach something similar to Alibaba, right, 21%. I think that's probably kind of like an interesting path to take and kind of a good guiding rail of where our margin should be. It should be something, kind of blended between probably like an eBay and a Walmart, because Walmart, right, like they buy the products and resell them in a sense. eBay, people just sell directly on their platform. So I think Amazon is like an interesting hybrid of that. So they probably have better than 7% margins on their purely Amazon business. Well, I mean, maybe they don't right now, but they should. And then from the tech side of things, the cloud business, right? Once that's scaled and up and going, like that should just be printing money. At least that's the idea. So I think, maybe getting up, and I think it's impressive that Alibaba operates at a 22% margin, but I know a lot of their business is or like fees as well. They have a lot of wholesale fees. So if you want to like sell on the platform, you just pay them straight cash and then you just sell your products. So like that stuff comes in 100% margin basically, right? From a gross margin perspective. I know their cloud loses business, and then they take anywhere from like a 0.5% to 5% commission on GMV. So Alibaba is an interesting one for sure, but I think Amazon should be able to grow margins that way. And maybe the next decade might be too aggressive. Maybe they're going to continue just expanding like weeds for the next decade and a half. Who knows? But we'll model it out in the DCF, which we'll be putting out in a couple of days. So thanks for tuning in. I hope you found this a little bit interesting and useful, and we'll refer back to this probably a lot when we're building the DCF, just to kind of make sure that our assumptions are headed in the right direction. And we have EBITDA projections in here, so we can always kind of see if our EBITDA projections are kind of in line with Cap IQ, aka like Wall Street consensus. So we'll kind of refer back to that. But thanks for tuning in. Let me know if you have any questions or comments, and feel free, like I said, to download this model. It'll be in the description below. Thanks.